Hello, everyone. Welcome back for session 3 of our 6-part series. As always, we have a lot of information to get to. Before we do, I did want to do a little bit of housekeeping. There are a few options for you using GoToWebinar. You can either use computer audio or phone, so please choose whichever option delivers the best audio for you. The most important thing is this is an open panel discussion, so we are looking for questions towards the end. Please feel free to submit them using the questions panel within GoToWebinar. The most popular question that we get is, will we be sending out a recording? And that is an absolute yes. We will certainly be sending a recording out after this. So without further ado, let me introduce Mike Alec, President of Management One.
Excellent. Well, thank you, Nico, and welcome everybody. Thanks for taking time out of your day. I hope you'll get something out of this webinar. So if you're not familiar with Management One, I'll just give us a brief overview of what we do. So we exist really to provide financial security for our people, our employees, our clients, our affiliates, really our whole network. We're about financial security, which of course is the theme of this webinar. The way we do that is through merchandise intelligence and education for independent retailers. That's our focus. That's what we do. We try to do those things with generosity of heart, with courage, with curiosity, with adaptability, with commitment, with collaboration. Hopefully, we'll live up to that. Certainly, the current environment in which we're operating requires a lot of curiosity, willingness to look for new answers, and a commitment to keeping going, because it can get to be a slog at times. We know that, and we feel it ourselves. But we think we'll get there. Hopefully, this webinar will contribute in its own small way. I just also like to highlight that we've at Management One have made a commitment to increase the diversity of our employee base, our network, and we think that's important for the future and the health of our company. We want to contribute to, in the small ways we can, to social justice in America. So now I'll sort of dive right into it. Dive right into the meat of the seminar. So if we could just advance the slide to the next one.
Yep, it is.
So shifting trends, which the title of this slide is Shifting Trends. And the title of this presentation is Be on Top of Your Money. So you might ask yourself, well, what do those two things have to do with each other? I think there's two connections. First of all, I was really struck by this article in the New York Times from last weekend. It was one of the better discussions of the changes that are affecting the fashion industry, but I think it's really relevant to any retail industry, not just fashion, for those of you who are not in fashion. But here's what sort of this quote: even before the pandemic, the whole fashion industry had started to unravel. What happens now that no one has a reason to dress up? So that's a pretty provocative statement, but it really what it's about is about change, right? It's about being ready for change. It's about accepting the need to change and being able to change. So, in fashion, being on top of your money really means being on top of in retail, not just fashion retail, all kinds of retail. Being on top of your money means being on top of your merchandise. And the first thing to be on top of in merchandise is, do you have the right merchandise? Before you get into how much of it you need and when you need it, is it the right merchandise? And being open to that need to change that can arise and we've seen arising is critical. The other aspect in which being on top of your money connects to change is that if you manage your cash flow properly, if you build a strong balance sheet by paying attention to how you buy merchandise, you're going to have cash, you're going to be generating more cash, and that cash will allow you to pivot when you need to change course, to seize opportunities, to respond to changes. So I think that's really a key message for us, is to continue to be adaptable and respond to shifting trends in the market. That will generate the cash that you need to continue to thrive. So I'm going to now hand it over to Paul, who will dive into the nuts and bolts and really the core of today's topic.
Great. Hi, everybody, and thank you, Mike, very much. So welcome to our webinar. This slide that says the beauty of retail is if you make a mistake on Monday, you can fix it on Tuesday. I love that saying, and actually, this came from our CEO, Marc Weiss, who told this to me many, many years ago, and I remember to this day because it's really, really true. The wonderful thing about retail is that we can fix problems relatively quickly if we know what to do. Now, obviously, right now, American retail, as we know it, has really never gone through an event like this, certainly not on the magnitude or the scale that we're talking about. And what this really means right now, I think, is that the retail playbook is being written on the fly for a lot of retailers. But I'd like to start actually with the big financial lessons that we should all be learning from this pandemic right now. And we see it practically every day in Retail Dive, the Wall Street Journal, your local newspaper. We are anticipating losing in 2020 30,000 retail stores. And when you look at what those stores have in common, there are certain things that they do actually have in common. Number one, they have been working with a very, very weak balance sheet, too much debt, cannot handle liquidity challenges. And I think in general, they also had one other thing in common as well, a very cavalier attitude towards managing their inventory. Now, when it comes to inventory control, the basics still matter. Doesn't matter whether it's a pandemic, post-COVID, pre-COVID, during COVID, even in these volatile times, it is really, really important that we cannot take our eye off the important, your inventory, and pay attention. That's another thing I think that retailers that are doing better than the average have always done in their business. They've been very, very good at paying attention. So while some retailers are struggling, there are also those retailers that are surviving, and there are those retailers that are even growing. And the retailers that are surviving and growing understand that no matter what retail vertical you're operating in, there's a truth to retail, and that fresh merchandise sells. Today, inventory is actually more perishable than it's ever been because the pandemic has exposed retailers' vulnerability. Mike mentioned it. Things are changing on a dime. But that's something that has happened in the past many, many times. I'm an old enough guy to remember that 25 or 30 years ago when the ski industry was actually changed on a dime. From one season to the next, straight skis became almost unsaleable because of parabolic shaped skis. And that happened within months, and it changed the entire industry overnight. And those retailers that were not keeping their inventory rotating, that were carrying too much inventory, thinking that it'll sell as well as next year as it did this past year, were exposed. Now, what you see here is a report that we looked at. Actually, Marc shared this report with me, and I think it's very, very revealing. It's from our clients, and essentially showing, and I'll get my little highlighter out there, showing just in the last month how closely, and when we see this, our clients' sales are followed by receipts of new. So you're seeing, for example, in the dress business, over 475 and under 475, this retailer brings in 45, sells 62, inventory 63, marks down 69. Why am I bringing up those four metrics? Because those are the four metrics that count today. You'll notice I never brought up margin. I'm bringing up flow of new, inventory to sales, and by the way, we'll be talking about this as well today. The idea of how important recognizing mistakes, admitting mistakes, and taking markdowns. And so as you go down this list, you'll see that this commonality is pretty much evident through every category. T-shirt dresses, last month sold 41, brought in 46. This is something that we see in every client that we work with that's doing better than the average retailer. They're understanding the absolute importance of bringing in new, fresh inventory on a regular basis. And I'm not talking about every month. I'm talking about every week. Because it's really, really important that all retailers understand that how we look at inventory now and going past COVID-19 is going to be different. See, a common mistake, I think, for most independent retailers is that we hold too much inventory and we don't flow in enough new inventory. And post-COVID-19 success formula is actually to turn that on its head. The secret sauce really going forward is to hold less inventory and flow in more new inventory. Now that may seem like a contradiction in terms like jumbo shrimp, but it is actually the secret sauce. It's actually really the key to how retailers going forward, once we get past this, how those retailers are going to continually grow their sales, keep their cash flow in order, and keep their profits at a very high level and work with a very, very strong balance sheet. So the question I have for everybody on the webinar today is, what are you doing? How are you currently tracking your inventory fluctuations? Are you efficiently rotating your inventory according to the current situation we're in right now? Do we have too much? Do we have too little? Because one of the things that we have to learn to do is we have to learn to sell inventory more quickly. And retailers that do that understand that the longer inventory sits in your store, that asset very quickly turns into a liability. And are you tracking this? The retail truth is you cannot have inventory health unless you have a good plan. See, accurate merchandise planning is that if we don't have an accurate merchandise plan, generally speaking, our business becomes reactive. Now, what do I mean by reactive? We're responding to situations after they have occurred. A good plan, a proactive focus, is eliminating problems and mistakes before they have a chance to even appear or before they even have a chance to fester. The first rule of better control of inventory is actually starting with a plan. It's the first step to better control of inventory. It's guidance on how much to buy, when to receive it. It's a financial tool more than anything. And also a very important part of planning is benchmarking, because a good plan actually creates benchmarks. So how you evaluate how you're doing, how's your inventory health. Now, a little bit later in the presentation, Marc Weiss is going to be going over a lot of really important key metrics. The thing with metrics are in retail is there are a lot of them, and which ones are important and which ones aren't. And what Marc is going to do is he's going to evaluate which ones are good and which ones you need to look at, because these metrics are actually levers that you need to know how to pull and press. And that's how you're going to be able to really use data to help your business. Now, let me just explain a couple other things of why we believe at Management One planning is really critical today and in the future. Because a plan actually helps guide you through planning your cash flow. That, after all, is what a merchandise plan is. For many of our clients, merchandise can represent 45 to 60% of their business. So obviously having a plan around that, a framework around that, is critical. But it also identifies risks, and it also identifies opportunities. And it helps you set and achieve your financial goals. And let me just expound on this for just a minute. Too many people think that a budget or an open to buy is simply that. Well, I know how much I sold last year, so I'll just buy around that. There's so much more to it than that. Ultimately, a budget or a plan, a merchandise plan, must have a goal to it. Where do we need to be at the end of the year? How fast do we turn our inventory? What margin should we be using? And how many markdowns should we be taking? And finally, and certainly the most important part as well, structure. Structure around the most important part of your business, how you purchase and how you manage your inventory. So I'm going to deal with strategic planning and essentially 3 elements of this. There are more, but I wanted today on the webinar just to deal with 3. I want to talk about a really important thing, which I've already touched on, is flow. How you flow inventory in is the best way to increase sales and cash flow. Number 2, if we're in the fashion business, and I know not everyone on this webinar may be in the fashion business, but most on this webinar are going to have to deal with markdowns in some sort. So how do we deal with them? How do we budget them? How do we know how many markdowns we can take and still achieve our profitability goals? And finally, last and certainly not least, is let's not show profits on our financial statement at the end of the year, but no cash to pay the taxes. So I want to talk about that unusual concept that only happens in our business, the retail business, where we can be showing a high degree of profitability without the cash in our checking account to even pay the taxes on that profitability. So let's get started with this whole idea of new. Because first of all, as we tried to articulate in one of the first slides, it's not how much inventory you have, it's how much new inventory you have. New inventory is everything. It's always been amazing to me that over the last 10 years, where when Apple will come out with a new iPhone, and people will be camping out in front of an Apple store, waiting to get the new iPhone, which is essentially like the old iPhone. What is that all about? Well, it's all about human beings being exposed to something new and novel. There's been studies about this from a psychology point of view. Dopamine is released in our brains when we see something new and novel. Dopamine is a feel-good chemical that releases in our brain when we say we eat food we crave. It's actually released, I hate to say it, when we have sex. Dopamine in our brains is when we see something new, we see it as human beings as a potential to reward us in some way. That's why flow of new inventory is important. That's why it's everything. And that's why inventory in the future, during the pandemic and once we leave the pandemic, is going to be more perishable than ever before. The whole idea of change. Now, this happens to be just an example of one of our clients, but it's an example of a client that actually did a lot of business. Let me see if I can move this over a little bit. Thank you. So you can see that last year our sales were up 113,000. We did 657. But there's so much more potential in this store. How do I know, and why do I feel that this store went from 500,000 to 650 in 1 year, and we believe we can go from 650 to 963, which is our goal next year? How do we make that deduction? That's a pretty aggressive plan. You know why? Because we're looking at flow. We're looking at how much new came in. You see, last year we did 35,000 in March, brought in 64. This year we believe we can do 59,000, bring in 94. And look at the business on Flow Right, if you can see my little highlighter. In the peak of their spring-summer season, May and June, when in May they did 60,000 in sales but brought in only 40 new, and in June they did 63,000 and brought in only 22, there was a lack of power of new, of dopamine, if you will, going into our customers, releasing into our customers' brain, that we haven't really maximized our business. You see, all open to buy flow planning has to do with how much inventory do you need against last year and how much new you should have. Instead of flowing in 40, we should bring in 90. Instead of blowing in 20 in June, we should bring in 60. That's the secret sauce on how you want to grow your business today and in the future. A flow chart, which is planning, a flow chart to have the right amount of new inventory coming in every month and every week. Let me just move this a little bit. Now, part of this, of course, is going to have to do with the fact that we as human beings also make mistakes. In fact, I believe that making mistakes in failure, if you will, on investing in inventory is the only way we grow, because it's the only way we learn. Mistakes are part of our business, and markdowns are the tool to deal with those mistakes, and they are the tool to generate inventory health. Now, there are some basic rules on markdowns. And the first thing that we need to know, this is particularly if you are in a vertical that markdowns are part of your business, can't get away from them, so we should plan them. In other words, what should I mean by planning them? We should know how many we can take. What's our budget? And then what I believe is true is that once we have a markdown budget, we should never, ever be under it. Why did I say under and not over? Because always turn, and new trump everything, even if we have to take more markdowns than we should. And by the way, the old adage about our first markdown is the cheapest, that is 100% correct. And typically 80% of the people that think that's correct think it's correct for the wrong reason. It does not mean the first markdown you take is a tiny, itsy bitsy one. It means the first markdown is your cheapest when you know that markdown is going to work. And markdowns have to be, in some cases, taken out in the back and shot in the head right away. And if that means the first markdown you take that you know is going to be gone in a week or 2 weeks is half off, then that's the markdown. Because everything is opening up cash and shelf space for new. That is the key, because we're going to be turning our inventory faster. Now, I am not going to tell you that markdowns are not without a cost. They are. They're an expense. They're an expense that doesn't even show up on your accounting statement. They're hidden in cost of goods sold. But still, on every expense in your store, we need to learn. And I think markdowns are also something that we need to learn from. Why did we take it? What was it why didn't it sell? And what did we learn from that so we won't make the mistake again? In some ways, markdowns are a little bit like the tuition you pay on the education of your customer. And I would urge you all, do not be afraid of paying that tuition, because it's going to be how you grow your store. Now, some retailers never learn the lesson. What we have here in one of our reports is a retailer that is buying dresses, and he or she loves dresses. Why do I know that? Why do I know this retailer loves dresses? Because if you go to the bottom of this report, for the last year, we've sold $1.4 million in dresses over here. But we bought, in a business we sold $1.4 million, we bought $2 million at retail worth of dresses. Now, that's simply not going to work from a budgetary perspective. That's simply, if you are going to buy that much more than what you can realistically sell, yes, you're going to take markdowns. But the markdowns that you're going to be taking are not from generally mistakes. The markdowns you're going to be taking is just to stay ahead of the deluge of new dresses arriving every day, much greater than what we can sell. And those markdowns are the key cause of excessive markdowns for retailers, and they're called from overbuying, buying more than what we can realistically sell. In this case, if you drop down to the sales in dresses from last year, 59.7% of our sales in dresses, or $861,000 at cost, is our purchases. Now, this retailer could be faced with the fact that we won't mark them down because they're an expense. This retailer at least recognizes we've got to keep flowing in and out, but it had the damage to the maintained markup or gross profit is down below in the lower right, 43%. You see, this retailer needs to be at 51% profit, but the 43% is where we're at. Now, how did that happen? And how do you use data to really understand what happened in the past and how to fix things in the future? Well, first of all, if you're buying $2 million to sell 1.4, at some point the realization hits that we've got way too many dresses. And so in this case, the last 3 months, this realization for this retailer hit, because in the last 3 months, we stopped buying. In other words, we took one problem and mistake and turned it into a second problem and a mistake, because the last 3 months we stopped buying, we only received $300,000. We're selling off inventory at $600,000. That may seem like a good idea, and generally in this situation it is, but it created the second problem. And the second problem is that if you see the top, the sales have started to go down, with the exception of May, every month from March, April, June, and July. We are continually losing revenue. Why would we lose revenue? Because there's not enough new. We don't have enough dopamine in our customers' brains. We stop buying new, and that's when the customers stop buying. Now, there's an adage, or not an adage, there is a how would I call it, a metric, I guess, in accounting called cost of goods sold. And on seminars that I give around the country, I've often said that cost of goods sold, one of the most important metrics in retail accounting, is also one of the most misleading metrics. You cannot run your business by cost of goods sold. Why? Because it is what it says it is. It is the cost of goods sold. Let me give you an example. You've received 20 widgets. At the end of 5 months, you sold 4 at full price. Yet based on those 4 that you sold out of the 20 that you received and paid for, your cost of goods sold would be excellent because you didn't even have to take a markdown. Your cost of goods purchased, however, tells us a totally different thing. And no retailer has ever gone out of business because they have too much cash. Cost of goods purchased is a key metric that I want everybody that's on this webinar to go and look at their financials and stay away from cost of goods sold and find out how much am I buying and how much am I selling, and does that match with my profitability? Because if the retail truth is that your profits and your cash flow is your inventory, it's everything. So let me do a really quick accounting statement, and maybe this will help illustrate. I've got two illustrations on this before I turn it over to Mark. This is a store that does $1 million in business, and their accounting statement is very basic. Our beginning inventory is, this is their income statement. $250,000, we purchased $700,000. Our ending inventory cost was $350,000. Our cost of goods sold is $600,000. We take our sales list, our cost of goods sold is $600,000. We get a gross profit minus expenses gives us net profit, which we pay a tax on. Pretty standard income statement. Now let's follow the money, as they would say, as Deep Throat would say, and all the president's men. Because the money is cash in, cash out. Cash out is purchases were $700,000 at cost. Our expenses, which was everything besides merchandise, our rent, our payroll, being the two big ones, $350,000. Our cash in was the $1 million sales. Our cash out was the $1,050,000 in a store that just paid a check, probably if you're an LLC or a subchapter S corporation, 32% of the 50, just wrote a check for $15,000 or $16,000. You should add that to the deficit in cash of $50,000. How could that happen? How do you show making money when you have no money? It's the difference between cost of goods sold and cost of goods purchased. Because the problem with this is just one number. It's the purchases. Why would this retailer be purchasing $700,000 at cost on $1 million business? They're overbuying. And that overbuying ends and creates havoc in retailers' income statements. This is a sample of actually a client that we work with that we pointed this out. And the good news is, and I'm sure Mark will tell you this, we just did an audit of a lot of our clients. Very few of our clients have this problem anymore. But in this case, this would be, if you look down below, this would be $980,000 business that we bought $1.4 million, and this must be the same guy who was buying dresses. And so we have $590,000 cost on $980,000, which is 60% cost of goods purchased. If we subtract the $590,000 invoices from our sales, we have $390,000 in cash flow. But when we look at the gross profit, which is essentially being based on markdowns and what our maintained markup is, that number is 50% of $980,000 or $498,000. What does that mean? That means that we have $100,000 difference between our profits and our cash. We're not paying attention to cash. That may be why you see over here this retailer is sitting with $40,000, $50,000, $60,000 more inventory than just last year. This is all part of planning. This is all part of paying attention. This is all part of how, when we leave this pandemic, we need to be smarter and better and pay attention. And I can't think of anybody that's better at paying attention than our CEO and a guy who knows this business better than almost anybody I've ever met, Mr. Marc Weiss, who at this point is going to be illustrating exactly the key KPIs or metrics and why they matter. Mark, I'm going to turn it over to you.
Okay, thank you very much, Paul. I think we're turning the presentation over to Nico. Right, thank you. Thanks very much, Paul. I'll try to live up to that introduction. Paul talked a lot about the P&L side of the business and the cost of goods and the profit in which you show, and that's critical and important. So the question comes up is, well, how do I not get into that? How do I buy right? What metrics do I look at? And there are inventory performance metrics that measure your inventory health in the same way a balance sheet measures the financial health of your business. So if you look at a financial statement, there's two parts of it. There's the P&L, which is what Paul just went over, and there's the balance sheet. And the balance sheet is really the health part of your business. It's what are my assets? How much cash do I have on hand? What are my debt? What do I owe? Do I have enough cash to pay all my debt? Do I have enough inventory and cash together that if I liquidated my inventory, I could walk away with cash in my pocket? We're not going to go through an accounting course here, but it is important to recognize that the healthier you can make your balance sheet, the better nimble you are and the more flexible you are, as Mike talked about at the beginning of this, to be able to create the change you need to create. So if you've got to shift gears or you need to start bringing in different product than you carried before, you have the cash available to do that. You have the cash available to buy those vendors you always wanted to buy. And the way to do that is to continually invest in the classifications and categories and vendors that are working for you. We know that some categories are not going to be working. Dress clothes, dress shoes, except in certain areas, are going to be difficult for the majority of our retailers to sell. But there are other areas where there's tremendous demand. And I would also encourage you to read that article that was on the first slide. It really gives a pretty good look at the history, recent history of the fashion industry. So there's a couple of key metrics I'm going to go over: cash margin, gross margin, cash margin return on investment, which is a metric that Management One came up, that's a proprietary measurement, and gross margin return on investment, which is more of a look at the profit you've made. We're going to talk about turn and inventory efficiency. So we can go to the next slide, please. So let's talk about the difference between cash margin dollars and gross margin dollars, because that's exactly what Paul was talking about in his last slide. The difference between the cash I created and the gross margin I created. The cash margin represents the cash you have generated over the last 12 months to cover all your non-inventory purchases. And I'm going to show you some examples of that in the next slide. Gross margin dollars are the profit that you created over out of your the gross profit you've created to cover your that's available to cover your non-inventory purchases. And that more closely resembles the maintained markup or gross profit or cost of goods on your financial statement. So what we want to do is it represents a profit on your walls, but doesn't necessarily represent the profit in your checkbook. And again, I go back to the very good example that Paul gave on the $1 million business. Next slide. So if you look at cash margin and gross margin in this example, the 863 in these apparel classes, the apparel being the department, the classes, some of the classes being below it, identify that over the last 12 months, this store created $863,000 in cash margin. That's a difference between what they sold and what they spent on purchases. The gross margin dollars are $950,602. That's the amount of profit they've taken, but that profit doesn't represent also includes the on-hand inventory that at some point is going to have to be liquidated into cash. And over 12 months, you want to have your cash margin and your gross margin very close to each other. Those numbers should be in alignment. One of the things, and I actually had to spend the weekend finding a client where the cash margin wasn't greater than the gross margin, because over the last 5 or 6 months, our clients have done an amazing job of turning their inventory into cash. And in most examples, and I'll show you one, the cash margin is actually greater than the gross margin. But you can see that the cash margin and gross margin in tees is very close. In tops, it's very close. In sweaters, it's almost identical. These are good numbers. In dresses, also very close. But look at what happened to bottoms. In bottoms, we created $121,000 in cash margin and $132,000 in gross margin. Well, that means we have on-hand inventory that we haven't sold yet that's going to have to be sold, where the cash margin will catch up. But if we broke this bottom class down and we understood where the problems were, we could probably take advantage and make that number closer. Accessories is even a more interesting example because accessories tend to have higher initial markup, which could be the reason for the higher gross margin. But you can see we're carrying a lot of inventory we don't need to be carrying. And again, this is represented over the course of the year. So when you look at $161,000 in cash margin, that probably represents something like $330,000 or double that number in sales. That's a lot of sales to be planned in one category. If that category was broken down into handbags or jewelry or scarves or whatever is contained in there, well, they do have jewelry and bags broken up, but there's still a huge amount of inventory in a classification where a lot of things got lumped together. So I think if you looked at the subclasses or looked at the subclass structure in this particular example, you might find some opportunities where there's a lot of inventory and not sales, and a lot of sales and not enough inventory. And that's a matter of right sizing your flow, which Paul talked about, and getting balance to your inventory. This client, for example, has an opportunity to get their cash margin greater than their gross margin, which creates more cash on their balance sheet, which gives them more opportunity to take advantage of a changing marketplace. Next slide, please. Then how do we look at this? Well, those are numbers. We can also see cash margin return on investment represented as a metric and gross margin return on investment represented as a metric. If you can go to the next slide, please. So in this case, it's the same example. The cash margin return on investment was 4.51. It's a very good number, by the way. And gross margin return on investment in profit dollars is 4.97. So what this says is for every dollar that I invested, I got $4.51 back over the course of the year. In gross margin, I got, for every dollar investment, I got $4.90 back. But that means I've got more profit to pay taxes on than I actually have in cash. It's not a really big deal. These are pretty close numbers. But if there is a big spread in your business, that indicates exactly what Paul talked about before. Too much inventory, not enough cash. And again, this is measured over the course of a year. If you look at jewelry and accessories, the cash margin return on investment is low, and in accessories, it's particularly low. I mean, it's a 4.13 is a good number, but think about the cash that could be created if that was measured, the flow was better, and we were buying into the right subclasses better than we're buying now. If our gross margin return on investment was 5 instead of 4, if our cash margin return on investment could be at 5.12 instead of 4.13, that means for every dollar that is invested in jewelry, I'm getting $5 back. That means I'll probably have another $40,000 or $50,000 in cash based on the same investment, just by buying better and buying right, which goes back to having a good plan. So why do we look at these numbers? You notice there's no maintained markup, there's no gross profit. These numbers represent how well I'm selling. For every dollar that I invest, I'm getting $4 back or $4.51 back in the course of the year. I know from those numbers that that's more than enough to cover my expenses, depending on my expense structure, if that's in line with my sales. Next slide. So we have a concept called turnover, and it's expressed over 12 months. It represents the rotation of your inventory over the last 12 months. And then we have another tool, what we call inventory efficiency, which represents the relationship of sales to your total available inventory in the last 12 months. It's similar to a sell-through report. I think this is a critical number to look at because it really tells you how good you were at your buy over the course of the year. How efficient were you in your sell-through? If we go to the next slide, this gets represented differently. So you can see in apparel, the turn is 4.53 and the efficiency is 64.41. But in tees, it's very good. The efficiency is 71%. That means that they did a great job turning their inventory, but they also did a great job selling through their inventory. That 71% says, I started with X number of dollars in inventory. I landed X number of dollars in inventory over the course of the 12 months. I take my sales and I divide by that, and it tells me basically what my sell-through is. In a fashion store, anything in the mid 60s to high 60s is very good. In low margin stores where you have 20 to 30%, you need to have efficiencies in the high 80s, low 90s. The larger the spread between your initial markup between 55 and 75 or 80% has a direct has a relationship to what your efficiency can and should be. So if you look at denim, for example, the turn is 2.38 and the efficiency is 5.195. That is not good. What that means is I've only had about a 50% sell-through on my denim, and I'm carrying a lot of denim. I've got a lot of non-performing styles in there. It's probably something where Paul talked about, we really need to use markdowns as a tool to get the efficiency up, even if the turn is not that great. So turn, we did get a question during the week on turn that we were asked, that Fred Weissman asked us to talk about. How do you evaluate a faster turning vendor a vendor who will only offer net 30 turns versus a slower turning vendor who will offer extended dating, say 90 to 120 days? That's a great question. And the answer to that question is rotation of inventory. If you're investing $1,000 and you've got to pay for it in 30 days, you're going to want to sell it in 30 to 45 days and get your money out of it. And if you can do that, that's better than spending $1,000, having it tied up in the store for 90 to 120 days to sell it through. The reason that's critical today, the reason rotation of stock is important, because clients want newness. Clients are on their cell phones, they're looking at inventory every single day, they're shopping you, they're shopping everybody else. They want to see what's new. If they know that what's new in your store is 120 days versus your competitor who's 30 to 60 days, they're going to shop first. It's why Zara has more visits per customer over the course of the year than anyone else, because they push newness. So that the basic reason is, if you want to capture market share, which is what you have to do in today's retail environment, you do it by staying fresh, staying new, watching the relationship of your sales to your purchases constantly, and building and spending money in the classes where you really need to spend it, like in tees, like in tops, like in sweaters. Look at sweaters, 4.73 turn, very good turn, and a 72% efficiency. Dresses, also very good. Then look at shoes, not so good. And then jewelry, not so good. And accessories, not so good. It's average, it's not great. There are good turns, but the efficiency of the inventory, the more efficient your inventory, the more the health of your business, the more cash you're creating, the better your financial balance sheet's going to look. Next question, next slide, please. So here's a men's store for menswear retailers. This is a sportswear department, and I broke it down by, I pulled a multi-store location for a very good reason. In this case, the cash margin's 808, the gross margin 757. Good cash margin return on investment for a men's store, very good GMROI. Notice the cash margin return on investment is better than the gross margin return on investment, and the turn's pretty good as well, and the efficiency is outstanding. And this is in sportswear. This is actually a men's store that's better, has better efficiency than the women's store I just showed you, which is usually just the opposite. In the first store, obviously they do a lot of business there. It drives a lot of it. You can see the numbers look good. But let's get down to where we have 5-pocket denim and 5-pocket non-denim. You can see that in Orbitville, the numbers look good. The efficiency is great. The efficiency is at 90%. There's a good chance that even though the turn's only 2.74, they're missing business and they're not flowing enough business in to meet the demand that's actually there, because you're selling through product very well. Even in the other two locations, even though the turns aren't great, the efficiency is very good. And I would argue that in Smallville, so I'm a Superman kind of comic kid growing up. I'll admit I was a superhero fan. But I will say, if you take a look at Smallville, for example, even though their gross margin is 15,000, their CMROI are 2.63, their GMROI is 1.96, their turn is 1.9, they still have an inventory efficiency of 84%. So if you go and do a deeper dive, which I did in this client, I found that they didn't flow inventory in at the beginning of the season when there was really demand for it. And sometimes you need, in slower volume classes, sometimes you need a slower turn and you need more assortment, but if you can be a little narrower and deep in the right product, you can grow the business. I would target this class in this store, and I would challenge the retailer to do more business here. If you look at, you almost see the same thing in 5-pocket non-denim, where this store did in cash margin dollars, did more than they did in 5-pocket denim, had a phenomenal turn, had a pretty good efficiency, but they fed this class more, so it did more business and it created more cash margin. So if you look at a lot of classes, if you can pick up $10,000 or $12,000 in cash margin in a class, in the key classes, that can translate to a lot of return cash back to you. Again, we're not looking at sales, we're looking at cash margin return on investment. So rather than just looking at how you're going to build a classification, look at the opportunity in the classification where you could add another 10, 15, or 20,000 in cash margin if you just flowed it differently, built it differently, and looked at a report like this. It tells you where the opportunity is. And I think in Smallville, for example, in 5-pocket non-denim, there's an opportunity to do more business, and the same in 5-pocket denim. And I would say also in the main store, there's opportunity there as well. Next slide, Pete, please. So how do you get these? The importance of, and we went over in previous webinars, the importance of a vendor performance report by classification. If you want that report or that spreadsheet, you can download our playbook on our website. But narrow and deep is better than wide and thin. Less is more, especially when it comes to vendors. 2 to 5 vendors per class is max, depending on annual volume of the class. It keeps you from duplicating. If you go wide and thin, you sell 1 or 2 items, then you don't have anything to get back into. You're also not important to the vendor. So we go into clients where we'll see, in a $1 million or $2 million store, they've got 2 to 250 vendors. It's way too many. You're writing ridiculously small checks to vendors. So be wide. Don't be wide. Don't be thin. Don't buy a top in 12 colors. From four different vendors. You can't even merchandise it well. It's better to buy 4 to 6 tops, like a polo, in 4 to 6 colors. Go deep, so you've got some meat there. So when you sell one, you've got another one to sell. Look at classifications that represent multiple seasons. So have classifications that are year-round classifications, but have classifications that you can really build and do business in different seasons. Obvious ones are long sleeve knits or sweaters in the winter, fall and winter, short sleeve tees, but think about graphics and basic tees. There's a huge business just breaking those up. So classifications are stronger in certain seasons. Watch them, pay attention to them. They'll help build and grow your vendors. Today, look for vendors where you can get back into goods. Some vendors, even today, are willing to hold goods so you don't have to. If you can do business with them and they sell well for you, and you can build a good relationship with them, and you have a good plan where you can show them what you're going to be buying over time, I would definitely look at that. And hustle. Track your data bi-weekly at a minimum, especially sell-through. Sell-through is key because it goes back to managing your markdowns that Paul talked about. If you don't hustle, you don't track, you don't look at those kinds of things, you're going to be behind your decision making. Look for vendors that can build your merchandise mix. If you're doing well in certain classifications, how can you build on them? One of the things I've challenged our footwear stores with is, if your business right now is all about athletic athleisure shoes, both performance and non-performance athleisure shoes, that's where the business is right now. Well, why not bring in activewear lifestyle clothing? Don't just think of yourself as a footwear store. Think of yourself as a lifestyle. If I'm a customer and I'm buying athleisure shoes from you, there's no reason why I won't pick up a cool pair of sweatpants or a cool top or something like that. So think about building your assortment based on what your customers are buying. You may not be selling dress shoes, but that doesn't mean even if you're a shoe store, you can't be something else. You don't have to have a full assortment of clothing, but think about the lifestyle of a customer. The world is changing. Just like that article, the guy used to be in the high elevated fashion business. Today he's selling sweatpants and sweatshirts. Add vendors that can add significant volume to you. Subtract vendors that offer small meaningless, that you're going to give small meaningless orders. It's a waste of time. It's a waste of money. If you can't buy enough from them that they mean something to you, don't buy them at all. And subtract vendors that you cannot get a quick sell through at a full profit. If you can't sell through your goods quickly at an 80 to 85% profit, then you don't want to do business with them. That's why, again, you want to go back and look at your vendor performance report. Don't be afraid to keep bringing fresh goods in. Even now during the pandemic, one thing we know for sure is in the key classes where there's business, the people who keep putting their foot on the gas pedal are accelerating their business. They're creating cash. They're finding ways of getting out of their old inventory. They're dumping it. They're selling it over time. Whatever your strategy is, depending on the kind of store you are, you've got to focus on fresh. And front loading is archaic and does not fit into today's assortment planning. Customer gets bored. They see too much inventory. They know they can wait you out. You need to bring in enough inventory to have an assortment and a selection, but you don't have to buy the whole season at the beginning of the season. Next slide, please. So that's my commentary. Those are that's my thoughts a little bit on assortment planning. Certainly our key metrics on cash margin, gross margin, inventory efficiency. These are important metrics to be looking at as you begin to analyze the data that exists within your own business.
Excellent. Well, let's open it up to a few questions. We have about a half a dozen questions here, Mark, on the same topic. And I know we make a very conscious effort not to sell in these webinars, but a lot of people are asking the reports that you're showing, where is that coming from?
Well, those are reports that we create for our clients. They're metrics that, we've been at this for 33 years. So we've kind of figured out the metrics that make sense, that we build into Be Aggressive, where I've always believed in playing offense, Nico, and these are the metrics that allow us to play offense so retailers at the same time can mitigate their risk. The gross margin return on investment, almost any point of sale system, you can run that report. The inventory efficiency, you can create that report on your point of sale system. Almost every point of sale system I'm aware of you can sort and you can look at what was my beginning inventory at the period, how much should I bring in, take that as your denominator, take the sales for that period as a numerator, and you'll have a sell-through report. So, but again, run it by class, by vendor. I think the gross margin dollars, you can take your gross profit and multiply that, or your maintain markup on your reports, multiply that by your sales over the period, and that'll give you your gross margin dollars. Most of that information is available. The only one that's not is, and that's because of proprietary trademark by Management One, that's cash margin return on investment. That's a proprietary metric. And basically we came up with that for a very simple reason, and that is people said, well, my GMROI can be misleading metric. If you don't take markdowns at the end of the season, your gross margin return on investment metric is going to be overstated. So we came up with, well, what's an accurate way to look at what did I get for every dollar I invested? And that was looking at the cash you actually generated. So the problem with GMROI, although it's considered the gold standard, it does have a flaw to it, and the Achilles heel in that is unsold inventory that you still get credit for and profit, but you don't get it deposited in your bank account.
Excellent. I'm actually going to unmute the mic for Miss Rita Phillips. She had a comment on vendors.
Okay, so I totally agree with Paul and what he's saying. That doesn't happen very often, Paul. No, I'm joking. Anyway, my question is that, in the collegiate retail market, it's been difficult with vendors. So trying to find those vendors who will allow those quick turns and new fresh goods has been very, very difficult, especially during the pandemic. But it's nothing new to our retail association. So, when we're dealing with the Nikes and the Coliseums where you have to order 9 months in advance. And then like the other day, we get a shipment from Nike, which if you have 72 pieces of a shirt and you got 12 and you got mixed sizes and you can't even put it on your sales floor. And those are our big vendors. So it really affects the turns and the profitability of what you're showing and demonstrating today. And I totally understand it. The issue we're having is to find those vendors that can allow that quick turn.
Paul, do you want to take that first, or do you want me to attack it?
I'll make just two really quick comments, Mark, and then I'll let you take it. First of all, Rita, nice to hear your voice. You know, we're going through a really tough time with supply chain, and you know, and it's affecting literally all our clients right now. And so the problem that you just articulated is pretty much going on around all the verticals. I think that this is a short-term problem. I think that this will get ironed out, and when I say short-term, over the next few months will be tough, but I think this will go away. And also, I think it speaks loudly to the whole idea of making sure your purchase order protects you from that. And I know, Rita, that you use your own purchase order, but I know there are a lot of independent retailers out there that are still using the vendor purchase order. And the vendor purchase orders are essentially written and designed to protect them, not you. So I would urge anyone that you should, and if you need help on creating your own purchase order to protect you from those kinds of shipments that Rita's talking about, you can contact us at management and we can help you with that. But Mark, I'll let you take over from there. Yeah,
I kind of look at it as, even though it's a hardship right now, and I will agree, you know, branded goods are being shipped late. You know, fast fashion goods are being shipped better right now. I think it creates an opportunity to look at new markets, to find new goods. And I think one of the things that is going to have to be, it probably will get ironed out over time, Rita, but I think one of the things we have to look at is making sure we're in contact with our vendors to find out what they're going to be open to ship and when. Because the business that we have to do, especially in the college bookstore where it's very concentrated, you need to have that information. But you also need to have a backup plan or a backup group of vendors that you can go to, that you can do business with. And this is where I think there's opportunity. And Mike, if you're still on, Mike comes out of the trade show business and probably could touch on maybe taking a look at some trade shows that you haven't been to before to fit the demographic needs of your client. So for example, if I were in the college bookstore business, I'd want Champion because I know that those fleece and those sweats sell well. Maybe you have those and they're not shipping too, I don't know, but
no, they're performing well, and that's where we're turning. But it's this Nike, you know, we're a Nike school, and so people want to wear what the coaches got on, provided we have football, which the Big 12 voted that we're going to have it. But I think that's our issue, is that they kind of have us, you know, like we know we need to have it, and so, but we're at their mercy, and it's been very, very difficult. And honestly, this isn't new since COVID. This has been going on now for a couple of years.
Well, one thing to think about, I mean, does Nike prevent you from carrying other shoes?
No, not at our school. There are other schools though that it is an issue.
Because there's other brands, and not everybody buys shoes just for performance. They buy shoes for style, for look, for color, and you know, maybe you start to build an assortment with other vendors that you know, will protect you, because you're going to sell the Nike. You're going to sell because Nike's a brand and people have brand identity and want to buy it. That doesn't mean it isn't an opportunity to grow that whole classification with other brands or with another brand that you could actually work with.
Right.
Brands like On or Hoka, I always pronounce it wrong. It's Hoka, but yeah. There are other brands out there that will work with you and potentially provide a balance to the dollars. Because if you're looking at creating, at the end of the day, Nike's going to create X amount of cash margin dollars for you. If you look at the classification, then how many margin dollars can we really create in this classification? If Nike contributes this and another brand or two contributes that, at the end of the day, you're still up. And if Nike doesn't deliver when they need to, you're not going to be down as much. So I think you've got a strategic decision and not just force Nike to put you in a corner. And actually offline, Rita, we can continue this conversation because we've got other stores that do huge Nike business, and we could talk about some other strategy that other retailers are employing, or even get a group of retailers together to discuss it.
Yeah, sounds good. Thank you.
Thank you,
Thank you.
Rita. I want to get a couple
Great.
more questions in here. We are running a little over on time, but I just wanted to get a couple more in. One of them from Lisa Schlesinger. She asks, if your post-pandemic traffic is awful due to your location, no markdowns will bring traffic, which I agree with. And we're actually doing a session on marketing, session number 5 on August 26th, because definitely traffic is going to be an important component of sales in turn. I wanted to unmute William Coleman as well. He had a couple of questions. Are you there, William?
So I would say this to that question though. Traffic is awful, and there's parts of the country, Manhattan, for example, where there's just no traffic. I mean, the Upper East and West Side are vacant of people, and the subways are empty. I get it, but you know, that's why we've talked about reaching your customer digitally and
exactly
bringing in new goods. So every situation has a challenge in front of it. But what we are discovering, the one thing we have learned, we always knew that fresh sold, but it's almost in an Uber model right now. I mean, one of the things that we said, a lot of people said, is nobody knew when the stores opened that the goods that came in March and April would be new to the clients who hadn't seen it before. But that didn't turn out to be true. They had seen it. They saw it online. They saw it in other places. So our stores that really put that inventory aside, sold some of it, got rid of a lot of it, but continue to bring in dollars into classifications that were working, and fed those classifications and looked at it every week, which is another reason we came up with the 12-week cash flow plan, was so that they could feel energized by the volume and the velocity. Everybody starts somewhere. You've got to build traction and velocity, even if it's only in 3 or 4 classifications, and stop looking at last year. Right size your expenses, get your business in line, and look at how much volume you have to do to be profitable, and then find those classifications where there's interest and excitement and you can sell to your customers. This is different. We're in a different world. We're in a world where you've got to be willing to look at adapting. I really encourage everybody to read that article in the New York Times that Mike started with, because it's a great article about this. I'm sorry, Bill, go ahead. I know you'd have a lot.
Can you hear me?
Yeah, we can hear you.
We do. Yeah, you were asking about, it's actually a good segue, because you were mentioning 12 months versus maybe a shorter window of time.
The report you showed was a 12-month rolling average, and I was just wondering if that's the best time frame based on the changing conditions, because obviously if you did a 12-month now, you're getting into pre-COVID months, where should the focus be on what's happening today, which is in the last 4 months, 5 months.
Yeah, you know, I wondered about that too, Bill, because when I started, so I did a lot of research on the reports that I showed, the metrics that I showed, and I was blown away by how many of the stores, and we've got a lot of stores. I was blown away by how well so many retailers have done at cashing out of their inventories. So I do actually think 12 months is a fair representation, even in COVID, because COVID will tell you, did I get out of my inventory or didn't I get out of my inventory? And I think you can drill down and really look at some good examples. And I'll just throw 2 out there. And I know we're running out of time and if people have to leave, but I think this is really an important conversation. If you've got a lot of backed up inventory, you've got to take a look, and let's say your metrics are poor, your efficiencies are in the 40s or 50s. Those classes, you've got to ask yourself, is that a class I can get back to and that's important? Is it not doing well because I just have too much old inventory? What would it look like if I brought in fresh inventory? These are the questions you've got to drill down and ask yourself. You know, if it's a class that you don't believe you can go forward with and get out of it over time, or find a way to dump it and focus on those classes where your metrics are good. You're not going to have great metrics in every class right now, but I do think 12 months gives you a really good visibility into what's working and what's not working. You know, we looked at that one class where it had $63,000 in inventory, and you could see the relationship between what they brought in and what they sold and what their markdowns were. Well, you can imagine that a lot of the markdowns are just being sold off of old goods, but what's really driving that class is new goods. So I would still look at a year. I think a year gives you a good representation, and I think COVID just adds another wrinkle of examination.
Thank you.
Thank you. And we did have just one, it's actually a two-part question from Tom Crawford. I'm going to see if I can unmute your mic as well. And Tom, are you there?
Yes, can you hear me?
We can.
Yeah, I'm not sure I'm asking it correctly, but the question is, you know, you want to keep this inventory a quick turn, you want to keep it new, and this is actually my wife's shop. I'm just the kind of IT guy, but she has done a great job, I think, about kind of creating urgency where she never has too much of one thing. Part of that is fear of buying too much, but how do you buy enough inventory where you get, you know, better everything, better shipping rates, better relationship with a vendor, but you're not overloaded on the floor? She only has the one store, you know, without looking like you're being kind of sleazy where it's like, oh, we only have 20 of these, and you come back 3 days later and there's another 20, right? So it's how do you maintain that urgency but also take advantage of more inventory?
Yeah, well, without sounding self-serving, that's why we exist. She's got to do a better job of forecasting how much inventory, how much business she's going to do by classification, and figure out how much inventory she needs to drive that business. You look at it as a relationship between sales and stock to sales. That's the simplest way to do it. If she thinks she can do $5,000 worth of business, and she can do it by beginning the month with 7,000 and landing whatever she needs to land, or start with 4,000 and land it, and look at it weekly. It's just a matter of having a plan, Tom. It's saying, here's what I believe I'm going to do next month. Here's where I need to start the month. Here's how much I need to bring in every week to continue to push that, and look at the relationship in dollars between what I own and what I'm going to sell. So, I mean, what a plan does is it helps you mitigate risk. It allows you to be able to begin to see, here's what I'm going to do, and here's how I maximize my opportunity when I'm going to do it. Here's where I need to peak my inventory. Here's where I need to get out of it. It's our whole reason it's a good part of the reason we're in existence. If you're going to do it on your own, that's fine too, but you need to put pencil to paper and come up with a spreadsheet and do some math on that. And again, we're happy to help you with that.
And just Mark, just so you know, this is Paul. Tom, how are you?
Doing good. We're meeting with Martin tomorrow to do our first plan. So
very good. I just want Mark, just let you know, Tom is a brand new client. He and his wife have an amazing store, and they're a brand new client, and they're going to work their first set of plans tomorrow. So great question, Tom.
Well, you'll be all prepared to challenge whoever's going to be working with you. So good.
we'll have plenty of questions. Good so far.
Excellent. So I wanted to cut it there. We have a few more questions that I think are more geared towards offline from a few of our affiliates and a couple of clients as well. We can handle those after. I did want to let everybody know that our next session on August 19th will be all about maintaining focus. There's so many things getting thrown at retailers in the last 4 to 5 months that a lot of people are just feeling the stress. And how do you maintain focus on what's most important? So we're going to be speaking with Marc and Dr. Linneman, and we look forward to everybody joining that session.
Yeah, I just want to speak to that quickly before we hang up and before everybody leaves the session. One of the things, I own a business, you all own businesses. We've been fighting the good fight since, the end of February, early March. And I think that there's tools out there that we can all use to keep our energy level high. We're on these webinars challenging you all the time, and I can see where that can become overwhelming. We're trying to give you tools to use for your data, but there's emotional tools. What's my emotional quotient right now to be able to handle this and persevere so that I come out on the other side? So there's a psychologist that worked with businesses who we work with, who's actually we wanted to actually have this be our first webinar. But he's so booked up, he didn't have any time to deliver to us until now. So I would encourage all of you to be a part of next week's webinar. I think Dr. Lindeman is, this is his thing, and he's had a lot of practice at it over the last couple of months, that's for sure. Thank you all very much for being with us today. We really appreciate it.
Thank you all.